All right, so everybody loves a good head-to-head battle, right? In the stock market, what's better than putting two stocks up against one another to see which one is outperforming the other? Lowe's versus Home Depot, ExxonMobil versus Chevron, Microsoft versus Apple, Amazon versus the world. Whatever way you choose to invest, what's obviously clear is that at some point, you're going to choose a loser when it comes to assessing one stock over another, right? When you're assessing one stock versus its direct competition, and yes, that's true, even if you're choosing an exchange-traded fund, which typically has a collection of dozens of companies inside of it. You just cannot escape the smoke, all right? Sooner or later, there will be something to compare and compete against in the market. That's our economy, and that in the market is quite literally what makes the world of finance tick. So today, I've chosen two popular ETFs to focus on and see which one of these is better than the other. From the video title, you already know those two ETFs are SCHD and VYM in a head-to-head versus battle. So let's get into it. The first and most noticeable difference between the two is the price point. As right now, an entire share of VYM is around $120, while the price of a full share of SCHD is less than $80 per share. So you're looking at a difference of about $40. And while that personally does not sway me in any particular direction, as an investor, it may have a different value for others who, in their mind, are looking to get more for their money, okay? More for the money that they have by purchasing quality stocks that are cheaper in price. Because although we know that partial shares are a thing, the average consumer isn't going to see it that way. They're naturally going to be drawn to the cheaper option. But if you're a newer investor, then I want to challenge you to consider looking past the steep price point and into the analytics and benefits of considering VYM as a better possible option. And I feel like I have to say this, all right, before I pull up this comparison chart and we get into it. We all know that past performance is not an indicator of future growth, but it does tell a story. So let's look at these two head to head and see what story is being told, or has been told rather, over the course of the last 10 years or so. All right. I have this pulled up, and this is on portfolioslab.com. They do have pricing packages. However, you can sign up for this absolutely free, and it does come with a ton of benefits that you can utilize. All right. Again, that's portfolioslab.com, and you can pit any two options or stocks that you want against one another. And it'll pull up the chart for you, and it'll do all the work essentially for you. All right. This is a great free tool to use, you guys. When you're comparing stocks, when you're looking at purchasing one stock versus another stock, if you don't want to buy both of them, obviously, right? This is a great free tool to use. And listen, I'm all for free tools, okay? Anytime I don't have to pay any money out of pocket, anytime I get to save some money or add or take that money that I would have purchased on a course or on something like this, and I can take that money and put it into the market, that's money I'm saving, and that's money I'm also making, and I'm putting to work, right? So I got to pull it up here, SCHD versus VYM. So let's start at the top. SCHD and VYM are both exchange-traded funds, ETFs, meaning they are traded on stock exchanges and can be bought and sold throughout the day. SCHD is a passively managed fund by Charles Schwab that tracks the performance of the Dow Jones U.S. Dividend 100 Index. It was launched on October 19th of 2011, so that's roughly, what are we looking at there? Roughly 13 years ago. VYM is a passively managed fund by Vanguard that tracks the performance of the FTSE High Dividend Yield Index. It was launched on November 9th of 2006. So that is roughly what, 18 years ago. So there's a bit of a gap, right? There's a bit of a gap. There's a 5-year gap in between the conception of both of these ETFs. Both SCHD and VYM are passive ETFs, meaning that they are not actively managed, but do aim to replicate the performance of the underlying index as closely as possible. Again, this does all the work for you. You've got the performance chart here that I'm going to scroll down and we're going to take a look at. Over to the right, you can see the key characteristics, and it pretty much lined it up for you right there. You wouldn't, actually, if you didn't want to, you didn't have to scroll past this, but they get more in-depth and detailed as you scroll down. But I want to take a look at the year-to-date return. Year-to-date return, VYM, okay, is nearly 3% of a higher return than SCHD. And I'm sorry, but that's big, okay? That's big. On the 1-year return, VYM is 4% higher, over 4% higher than SCHD. On the 3-year return, VYM is 9% versus SCHD 6.41%. 5-year return, here's where you see the difference between the two. VYM is 10%, okay? 5-year return on SCHD is 12%. That's interesting, right? 10-year return, 10% for VYM, 11.53% for SCHD. Let's look at the chart here. Let's get some context for this chart. SCHD versus VYM performance comparison. In the year-to-date period, SCHD achieves a 5.54% return, which is significantly lower than VYM's 8.15% return. Over the past 10 years, SCHD has outperformed VYM with an annualized return of 11.53%, while VYM has yielded a comparatively lower 10.07 annualized return. The chart below displays the growth of a $10,000 investment in both assets with all prices adjusted for splits and dividends. So again, this site is doing a lot of the work for you, okay? You just plug in whatever ticker symbols you want to go head to head, and it's going to generate the performance comparison charts for you. So right now we have the 6-month chart, and you can see that VYM is outperforming SCHD, but that's just over the past 6 months. Over the long term, you saw that on the 5-year and 10-year charts, SCHD has outperformed VYM. All right. There you can see the symbol name, the Vanguard High Dividend Yield ETF versus the Schwab U.S. Dividend Equity ETF. One of the things that I do, okay, if I like a stock well enough, or if I like an ETF well enough, depending on what doesn't matter, I'll buy both. And I'll live with that. You know, a lot of people get caught up, and this is what I don't want you all to do. A lot of people get caught up in buying one just because they want a clear winner, and they'll sit and they'll mull over. They'll focus on, oh my God, if I would have just invested all of my money into this versus another. You can't do that. Listen, if that's the case, you'll be sitting there doing that all day, every day. And if that's really how you feel, then just invest in the top 500 companies and put your phone down, right? If that's really how you feel about it. But a lot of people will compare these stocks, right? They'll make their purchase, and then they'll buy both, right? They'll buy two competing stocks or two competing ETFs. And then at the end of the day, or in this case, at the end of a 5-year span, they'll look at the other and say, man, I should have put all my money in the other one. I should have thrown all my money in that. You can't do that. You cannot do that, all right? You will be forever second guessing yourself if you do that, okay? I want you all to understand the differences between both. There's risks associated with both, right? There are differences associated with both. If you're buying both, you understand that. You're buying both for a reason. But for the sake of this video, let's continue on. You have the risk-adjusted performance, which this table presents a comparison of risk-adjusted performance metrics for Schwab, for SCHD and VYM. Risk-adjusted metrics are performance indicators that assess an investment's returns in relation to its risk, enabling a more accurate comparison of different investment options. So, in other words, they're basically saying, how much of a risk is it to invest in one over the other for your money? That's basically what they're saying. That's basically what a risk-adjusted performance is. You continue to scroll down. You can see the Sharpe comparison ratio, which the current SCHD Sharpe ratio is 1.25, which roughly equals the VYM Sharpe ratio of 1.73. The chart below compares the 12-month rolling Sharpe ratio of SCHD and VYM, and you can see VYM, again, is clearly ahead of SCHD, but that is for, again, just the last 12 months. Right, so in the short term, VYM has definitely outperformed SCHD. You go down here and you look at dividends, which is really the cream of the crop, which is what I like to focus on for my dividend portfolio. SCHD's dividend yield for the trailing 12 months is around 3.35% more than VYM's 2.85% yield. So, again, that is something else that you will want to focus on if you are looking at investing in these two. You're going to, especially for the dividends, if you're a dividend investor and you're looking to add one of these to your dividend portfolio, then obviously you're going to want to focus more heavily on the dividend payouts and yields for both of these. And it's obvious right now that SCHD is a higher yield payout than VYM. So that's definitely and certainly something to look that could sway your buying decision when you're going to make the decision over which one of these to buy versus the other. I have both. I definitely have more SCHD than I have VYM, but I'm comfortable buying both right now. But again, I nearly have, if I had to guess, and we'll pull up my portfolio maybe tomorrow, but if I had to guess, I have a ton more SCHD than I do VYM, okay? Again, because I realized that the dividend payout, and you can look at the payouts over the course of the last, 10 years, 10, 11 years, and you can see the difference here over the course of the years. And right now, SCHD is just giving a little bit more. Again, you continue to go down, you can see every single chart. They do all the work for you, the drawdowns, the volatility of each, and they even have a discussion board where you can comment and you can read other people's comments. But right now, what I want to do is, while we're looking at this, I want to go over the holdings, the top 10 holdings of each of these companies, so you get a better idea of what exactly is involved, what you're getting into when you buy VYM, which is the Vanguard High Dividend Yield Index Fund. So, for VYM, the top 10 are Broadcom, AVGO, JPM, JP Morgan Chase, ExxonMobil, Johnson & Johnson, the Home Depot, Procter & Gamble, Merck & Company, AbbVie, Chevron, and Walmart. Listen, I love every single one of those companies. I do. I don't have a problem with any one of these companies on the list. That is an excellent lineup of stocks, okay? Again, that is the top 10. And you can see its sector weightings over here to the right. You've got financial services, obviously leading the pack, followed by consumer defensive, which is basically all of your consumer stores like Walmart. Healthcare is following that, along with industrials, technology, energy, consumer, cyclical utilities, communication services, and basic materials. So you can see the asset breakdown for the sector weightings right there again, and the top 10 holdings. And I'm going to tell you right now that the top 10s for both of these, they're not too far off from one another. Because if we click over on the SCHD holdings, which I pulled up, boom, right there, you can see that a lot of the top 10s, about half maybe, are also within SCHD. So you've got AVGO Broadcom, you've got AbbVie, you've got Merck & Company, you've got the Home Depot, Texas Instruments Incorporated. I don't know how I feel about this company. I'm a little on the fence about purchasing Texas Instruments right now, but as well as Verizon. But they also have Chevron Corporation as opposed to ExxonMobil, Amgen, the Coca-Cola Company, and Cisco Systems. So there are a couple of these that I probably, if I were looking to purchase individually, that I probably would not do. But overall, that is not a bad 10 at all. I would not be opposed to holding any of these over the long term. So you also have the sector weightings here, which healthcare leads the pack, followed by industrials, very close behind, followed by financial services, technology, consumer defensive, consumer cyclical, energy, communication services, basic materials, and utilities. So again, the sector weightings are also very, 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 very similar. So listen, these two comparatively, if I had to choose, over the course of the last 10 years, the data is really there for you. You would have performed better if you had been holding SCHD over the past 10 years. Okay, but over the short term, let's say if you had bought in within the last year or two, then you certainly would have outperformed holding VYM over SCHD. So the question is one better than the other? Yes, SCHD historically has performed better than VYM in the long term. In the short term, which is what we don't really worry about in the short term, VYM has performed better. But again, you can obviously just go by both if you so choose to. But you all let me know what you think down in the comments. I hope this has been somewhat eye-opening, or somewhat if you've gotten anything from this video, do me a favor, hit a like and subscribe on the way out the door if you're not already. And I will see you all in the next video. All right, later.